In this video, part 4 of a 5-part comprehensive Beyond Meat stock analysis, I'll discuss the company's management effectiveness and why knowing how to measure management effectiveness of the company you're investing in is important. Welcome to MGA Investing. My name is D. I learned early and painfully in my investment experience that when you give a business money with the hope of getting your investment back plus a reasonable return, and you know very little about the quality of the management of the people that you're actually going to go into business with, that's not investing, that's speculating. And in this video, I'll give you my simple process of how to measure management effectiveness and move from speculator to investor. The process I'll be using to measure Beyond Meat's management effectiveness is called the D.U.M.M method, a process of stock analysis that requires no advanced math or technical chart reading skills, a process I've used successfully for decades. What is the D.U.M.M method? Well, D.U.M.M is an acronym. The D in the D.U.M.M method stands for Durable Competitive Advantage. It measures the strength of a company to fight off the competition and sustain profitability. U stands for understand, meaning, do I understand how the company makes money? If you don't understand how it makes money, how do you make sense of the long-term revenue prospects of the company? M1 stands for management. That is the management effective at operating the business? I use 5 key metrics to measure management effectiveness, which I'll cover in this video. M2 stands for margin of safety. That means, can I buy the stock at a discount? I devised this process to provide me a simple, reliable, and replicatable way to analyze stocks for investment without all the math. Don't get me wrong, I like math and accounting, hence why I earned an MBA in business administration, because it actually provides additional exposure to additional accounting and finance courses not needed in a business management MBA. It's just that I determined over time for most of what I needed for stock analysis, well, it didn't require a lot of math skill brilliance. This video deals with the first M in the D.U.M.M method, that is management. I invite you to, at some point, to go to the MGA Investment YouTube channel and view the first 3 videos in this 5-part comprehensive Beyond Meat stock analysis. The first video in the series is a general company overview. The second speaks to whether Beyond Meat has a durable competitive advantage. And the third is understanding how it makes money. I'll have the titles listed and how they line up with the D.U.M.M method and the descriptions below to make it easier to search and to find. Management, as I mentioned earlier, M1 stands for management, and this measures management effectiveness. In this video, I'll cover the 5 key metrics I use to measure management effectiveness. I'll summarize my assessment of Beyond Meat's management using my decision chart, where I'll rate management effectiveness on a scale of 1 to 10, where 1 is low and 10 is high. Here's a look at a recent decision chart that I completed on Teladoc. Now, you can see here I rated Teladoc 6 on durable competitive advantage, 10 on understanding how they make money, 6.5 on management, and 5 on margin of safety. For the D.U.M.M score, 27.5, and a proceed with caution symbol in regards to buying the stock at the time that video was created. Again, you can go back to the MGA Investing channel to watch the 5 associated videos that support my reasoning for the scores. This is the current Beyond Meat decision chart we're working through right now. And as you can see here, I rated Beyond Meat's durable competitive advantage as a 6 and understanding how they make money a 10. Now, again, if you want to know more how I arrived at these scores, I encourage you to go back and watch the previous 2 videos in this 5-part series. That first video was Beyond Meat stock analysis, hope or hype, and Beyond Meat stock analysis, how does it make money? And you can go back and refer to those videos. Now, let's dig through these 5 key metrics I use to measure management effectiveness. There are formulas to calculate all of these metrics, but I'm not going to spend any time on these formulas. If you want to learn more about these formulas, a simple Google search will provide you with a variety of examples and instructions. In today's world, these metrics are already calculated and freely available online, so I rarely need to resort to any formulas to figure out any of these numbers I'm going to show you. There are websites like ReadyRatios.com, CSIMarket.com, and MacroTrends.com that you can actually use for free to get many of these ratios. These websites, they'll provide a sector or industry average for these metrics. And I most often use reporting features provided for free within my Fidelity account for these metrics. One thing to consider when looking at these 5 key metrics I'm going to share with you is to use an industry or sector average. That will give you a more comparative average within that industry or sector. The first metric is ROE, or return on equity, sometimes referred to as net assets. Essentially, it looks at how much profit a company can generate relative to shareholders' equity. Based on my research, I think a good benchmark in this sector would be about 17% for ROE. ROA, or return on assets, which is how much profit a company can generate from its assets. Assets, of course, are things of value a company owns that can be converted into cash. A current benchmark, or a good current benchmark for ROA, would be 5%, based on industry comparisons again. ROI, or return on investment, measures the amount of a return on an investment relative to the investment cost, essentially return on cost. One of the challenges with using it is as an isolated measure is it doesn't account for how long an investment is held. A benchmark ROI in this sector might be somewhere around 7%. As I mentioned before, you can get this information from CSImarket.com. You can get it from ReadyRatios.com. And as I mentioned, I like to use my Fidelity account because this research, all of it actually, is provided for free. So one of the places I'm going to go to right now is Key Statistics. I want to talk specifically about those things that relate to ROI. As I scroll down, we're not going to talk about some of these valuation tools on here. That's in the next video. We'll just keep scrolling here. Oh, here's something I just kind of want to mention now, and we'll probably get back to it a little bit later. So one of the things I want to talk about here is free cash flow, all right? And so this one right here in particular. So this is the trailing 12 month. This is why this is important. And I just want to mention this, and again, I'll come back to this later. This gives us an idea of how much cash Beyond Meat is using. I don't want to say they're bleeding cash, but they're going through a lot of cash. And some of this might be understandable, and I'll talk about it later. I'll tell you why this is important, and then I'll talk about it again as it relates to debt to equity. But for now, it's important to understand year ended December 31st, 2020, approximately $114.3 million in aggregate expenditures used to purchase inventory and property and plant and equipment, acquire assets from Beyond Meat's former co-manufacturer, and pay loans, basically loan payments, net of all the borrowing. That's where you're seeing a portion of that money. So we'll come back to that when we talk about debt to equity. So here we go. We're talking about returns, and we're going to be right in this little category here. And let me just explode this a little bit so you can see it really well. So right in here we have return on equity, and we have a negative 41.3%. But what I want to focus on are going to be the trailing 12 months. So you can see here negative 23.37 is a number, and there's the industry average, 17.92. They're at negative 23.37. Then we look at return on assets, we see it's minus 11, right? And the industry average is 5.16. And I think here we said is a good number would be about 17%. And then here I think we said a good number would be about 5%. And then we look at return on investment. Beyond Meat is negative 12.08%. So let's circle those numbers up. And then we said a good average would be about 7%. And so we can see that they're underperforming in these areas. Now, some of this is understandable because of the pandemic, of course. We can understand some of that. These numbers aren't looking particularly good, but we also must remember the sector was hit pretty hard during the pandemic. Nonetheless, we'd like to see a trend with these metrics improving in the coming 2 quarters as the world hopefully comes out of the pandemic. Now let's take a look at debt. Scroll here. And what I mean by debt really is how a company uses and manages its debt instruments, because that tells me a lot about the executive intelligence. Debt is typically used to help finance critical business operations, but they can be used for pet projects too, right? And line pockets of executives or pay dividends to shareholders. Also, the structure of debt is also important to review. If I see large debt and not enough current assets to meet these short and mid to long-term debts, well, I get a little concerned. Beyond Meat has historically financed its operations primarily through the sales of equity securities, that's selling shares of stock, and bank borrowing. And when I'm looking for debt, I'm looking for bank borrowing debt that shows up on the books by way of long-term debt. And as you can see here in this chart, they are sitting on a mountain of debt, as we see here. So we see that there's this, it's fairly the same through here, but when we get here into this pandemic year, we see the debt go up. And so we understand some of that. And then we look here at shareholders' equity. We see that shareholders' equity has also increased, a slight decrease in this last year. But another alarming thing is, at least alarming to me initially, and I'll explain why, is this ratio right here. And that's that debt to equity ratio. And the reason for that is typically a good number is like 1 to 1.5 is what you'd like to see. These guys are sitting at 4.7. So what that means is they're carrying a lot of debt. Now, when you're at a 1 to 1.5, it can signal credit risk to the lender. And I believe JP Morgan is their principal lender. But I also understand that more recently they've paid down some of this debt. So this number we may see in the next quarter, it may have actually gone down because they paid down nearly $100 million in debt. So we may see that go down as well. But that's a number that I pay really close attention to, because if in fact that number remains high, they become a credit risk. They can't borrow from the bank at the rate they were. So that means more than likely to cover operational costs and expansion and acquisition, that has to come as a result of selling more shares. And so you know what happens when they have to sell more shares? Well, what happens is our current position gets diluted. So right now we own a block of shares. Well, that gets diluted. What it actually means is that we actually own more of something that's actually worth less because it's gotten diluted. And so that there's more shares available means that our share cost has actually gone down. So that's one of the things that you have to look at. Another thing I want to maybe just hit on just a little bit. Again, there's no doubt that some of this debt was used to cover overhead during the pandemic. And I've mentioned that before. And so when I look through things, it looks like the increase was due to maybe lower absorption of fixed overhead costs as Beyond Meat had to scale back their production, and they had to reduce inventory levels during the pandemic shutdown. It also had, because of that, significant write-off of somewhere about $10 million of excess and obsolete inventory. So they had you had those costs. There was also an increase in R&D, and the increase in R&D was mostly employee overhead. They carried on 65 or 69 additional employees, higher scale-up expenses, and higher depreciation and amortization expenses compared to the prior year. So this is that kind of that pandemic year, and then we can see that right here. So the general trend was improving, and the loss this size could be expected during the pandemic, of course. And however, the increase in 2020 was primarily driven by a year-over-year increase in operating expenses, which was to support Beyond Meat's expanded manufacturing and supply operation. And as I mentioned before, higher share-based compensation expenses, higher administrative costs associated with operating as a public company, higher restructuring expenses, and continued investment in innovation and marketing capabilities. Now, I wanted to switch back very briefly, just as we were talking about debt to equity, just some of these comparable numbers. Again, this is back in my Fidelity account. And we want to look at, we're going to find it here, that debt to equity. This is most recent quarter, but we want trailing 12 months. So the debt to equity, they're 93% debt to equity. So Again, you see an example of much more debt to take care of operations. And again, we explained that. But what we see in the food services industry is typically about 120% debt to equity. So that's kind of the nature of that business. So overall, Beyond Meat still not doing bad in that area compared with the industry average. So they're not doing too bad there. But it's always a concern when a company's about 4.7, anywhere over 1.5% or 1.5 in that ratio, a debt to equity ratio where they were 4.7. Another type of debt to look out for is off-balance sheet debt. And this is an accounting method used to keep some assets and liabilities from showing up on the balance sheet in order to keep debt to equity ratios low and improve the company's credit risk. Beyond Meat, fortunately, does not have any off-balance sheet debt, which is a good thing. We'll now move on to our fifth and final metric, which is management compensation. The reason management compensation is so important is because compensation drives behavior. Tell me where an executive pay comes from, and I'll tell you where and what his or her focus is on. There are several places you can go to get this information at no cost. You can, of course, simply just Google Ethan Brown compensation, and from there you'll be pointed to various websites like salary.com, ERIE.com, which is the Economic Research Institute, or execpay.com. These websites will give you some general information for free, like total cash, equity, pension, and other. Some may actually require you to unlock additional detail. Most of the companies listed are sourcing this information from the SEC Schedule 14A or most recent proxy statement. If you Google BYND 2021 proxy statement, it should come up in your search. It will look something like this. So we'll go ahead and click on that. So we're here. We found it. We want to make sure we have the dates right. We're trying to find the most recent. And then we're going to look for the index. So here's the index. It's usually down towards the final pages. And there we go. There's executive compensation. It says it's on page 56. So let's just go. So as we scroll down, you can see here they're using some peer group comparisons to figure out executive pay as well as CEO pay. Some discussion analysis. Some of this can be interesting reading. But we're going to bypass all of this and we're going to get right to executive compensation. What we can see here horizontally are the different pieces of his compensation. And we're talking specifically right now about Ethan. We can see here, we can look at his salary. We can see that his salary, although the company's not profitable yet, has increased, well, over 67% from 2018 to now. Not bad. We can see also here there's no bonus in 2020. There are some stock awards here, $2.2 million, some option awards, $2.5 million, and then we see all other compensation is $3,000. So all in, his compensation is $5.3 million. Now that's actually down a bit from the prior year, as you can see. So Ethan's total compensation was $5.3 million, down about $2.6 million from 2019, about a 33% decrease from the prior year. And so this could be a number of things, and that could be the result of either missed targets, or it could be where his compensation was earmarked after the IPO in 2018. You can see that the performance of the company is heavily weighted in these categories, so that a lot of their compensation is in this area here, stock awards and option awards. If the stock performs well and each of their compensation increases by hitting these particular targeted performance markets, stock awards and options awards are, again, a significant part of their compensation. When you look at Ethan Brown's compensation, you realize that his salary only represents just a little bit over 9% of his total compensation. It's a drop in a bucket, a nice size, howbeit, compared to the stock awards and options that make up a little bit over nearly 91% of his compensation. And you also probably noticed a big jump in compensation for Ethan Brown between 2018 and through where it is today. That's because the company IPO'd May of 2018. Not a bad bump in compensation. We can see that compensation is closely tied to the company performance, as I mentioned before, although it can be difficult for most people to understand that a CEO can be paid so well when the company is yet to earn a profit. As I mentioned, 90% of their compensation is stocks and options, not actual cash, although it is considered income and they can sell these options at their discretion once vested. Let me reiterate. Tell me where an executive pay comes from, and I'll tell you what he or she is most focused on. Nothing looks terribly out of place or out of line for compensation for Ethan Brown or the other executives compared to the industry size and age. But I want to make sure of, as a stockholder, when I'm reviewing compensation, that I'm actually getting what I'm paying for in terms of executive performance. I have to admit, these 5 metrics are all a bit tricky when working with growth companies without a 6 to 10 year track record of profitability. One thing is for sure, there's no crystal ball in investing. Even the very best investors with access to more information than you and I can ever get our hands on still get it wrong from time to time. But we use the best information we have available to make the best possible decision. Here's another website that I like to reference, and that is Guru Focus. And one of the things I like about Guru Focus is I like to go into here. I like to look at a couple things. One is ownership, right? And I like to see who are the big owners in terms of stock. And you see Ethan Brown, 1.5 million shares. It's a good thing. And then you can see some industry holders, how many industry holders actually own this stock as well. Bailey Gifford, Vanguard Group, BlackRock, some big companies, well invested. See Bailey Gifford, 6.7 million, Vanguard, 3.9 million, BlackRock, 2.2 million. So I like to look at that. And the other one I like to look at that's directly related to that compensation piece is what are the insiders doing with their shares? And so if we look at insider trading and see who's selling what and how many, because I like to see which of the executives is buying or selling their stock. I want to know, are they drinking the Kool-Aid that they're selling us? And if I see a lot of selling transaction when the stock is depressed, I get concerned. If I see some selling transaction when the stock price is high, I'm not overly concerned because they're doing what most people would do, which is milk the cow occasionally. That is to take a little off the top when the stock is overheated a bit. I don't see much cause for concern in what I'm seeing here in terms of who's selling and who's buying. So we can see the executives here. So pretty good sign. I like what I see there. Based on my research, I give Beyond Meat a score of 6.5 for management effectiveness. There are some obvious challenges with the 5 key metrics. They meet only one of the metrics, in my opinion. Debt to equity is still a concern, even though I know they have recently paid down a large portion of their bank debt, which I discussed earlier. So I'll have to see how they close the gap on lowering that number closer to 1.5 in the coming quarters. And to be fair, the pandemic was tough on the company, as it has been on most companies during the pandemic. So I'll have to see how they perform coming out of the pandemic. Let me know if you agree with my score and assessment. What would you score management effectiveness? Would you score it higher or lower? Leave me your response in the comments below. There you go. A look at the 5 key metrics I focus on when I'm trying to measure management effectiveness and determine if the right executives are in place to execute the business plan in accordance with long-term goals. Thanks for watching. If you found this video of value, please smash that like button and subscribe so that you can catch the next video in this 5-part comprehensive Beyond Meat stock analysis. And in the next video, I'll review the second M in the D.U.M.M method, margin of safety. Here, you'll learn how to spot the most opportune time to buy the stock. We'll see you in the next video.